Every time you look at the financial news, there seems to be some new data that will make a change in the market. And if you are like some of our clients, you are wondering if you, as an investor, should care about each specific one. At Visual Sectors, we love data, but what we love even more is helping you understand how to use it. So today, we are diving into the world of inflation. And no, this won't be an economic lesson. Within the next 10 minutes, you will learn how CPI impacts the markets, the patterns our team of analysts found, and how to use them in your investment strategy. So let's start with the basics. What is inflation data? Well, it's basically a measure that shows how prices are changing over time and gives us an idea of where the economy might be headed. And as you can imagine, this information is pretty important for investors. But here's the thing. Not all inflation data is created equal. You might have encountered core inflation, CPI, PPI, PCE, or even PCEPI. And even though all these metrics have a specific role in helping to understand the economic landscape, you don't need to analyze every one of them to adjust your investment strategy. That's why we're focusing on the Consumer Price Index, CPI, today. CPI is a measure that captures the average change over time in what urban consumers pay for a basket of goods and services. It reflects the changes in households' cost of living and is a key indicator for policymakers and investors. In the US, CPI data is released every month. Since this represents the cost of living, it also indicates households' purchasing power. This can affect investment valuations, interest rates, and even consumer behavior. It's crucial for investors to understand how inflation influences financial markets. Let's take an example. During periods of moderate inflation, consumers might have more spare money. They will buy more. As a result, corporate earnings and stock prices will be boosted. On the contrary, if inflation gets too high, central banks may need to tweak their monetary policy, often resulting in higher interest rates. And that can lower the present value of future cash flows, making stocks less attractive. But here is where things get really interesting. When our team of experts started analyzing data, they found patterns showing how the release of CPI data impacts not only the broader market, but also has sector-specific effects on ETFs. And how, by examining these patterns, investors can gain a strategic advantage in predicting market movements and making smarter investment choices. So let's take a closer look at our findings. We've analysed data from December 2018 to January 2024 and found that the effects of CPI releases extend beyond short-lived market fluctuations. In fact, they can impact sector trends and performances over a prolonged period. And here's where it gets even more specific. We've identified varied sensitivities across different sectors when it comes to their reaction to CPI surprises. For example, while many sectors show a robust positive correlation between options positioning and their subsequent returns, others, like real estate, energy, and finance, exhibit a negative correlation with CPI increases and surprises. But perhaps the most exciting finding from our analysis is the significant impact of monetary policy on the ETF QQQ performance. Let's take a look. November 14th. Federal Reserve has long stopped rate hikes. CPI report comes out better than expected and better than the previous one. The headlines of November 14th and 15th were dedicated to the Biden-Xi Jinping summit, but the positive was dedicated to the policy shift. That report was said to be the final proof that the Fed would stop raising rates, while the consensus had been there since July. And when we looked at the QQQ ETF, an equivalent of Nasdaq index, here is what we saw. Decline of open interest in puts by 2.8% on the 14th of November. Decline of gamma by 1.6% on the 14th of November. Increase of total growth bets by 2.9%. The next 6 weeks showed the ETF gain of 9.3%, while the model predicted 10.7%. Don't worry, we won't detail every pattern we found in this YouTube video. This was just an example, amongst others, to illustrate how QQQ reacts to CPI and is consistent with larger patterns. Our team of Wall Street experts compiled everything in a document for you. So, how do you use the patterns we found to adapt your investment strategy? We asked Brian, our chief analyst, to give you 2 examples.
Thanks, Josh. To think about how we can use this data for our own trading purposes, let's first get an understanding of what our expected values are. We know from studying the data that if we get a bullish signal from our CPI study, we can expect the NASDAQ ETF QQQ to return 10.7% over the subsequent 6-week period. Whereas when we evaluate the population data, we see the expected 6-week return is only 2.31%. This means that we have an expected excess return over the population data of almost 8.5%. This creates a significant deviation over our baseline expectation, and we definitely want to take advantage of that. When we have this type of expectation differential and we change our investing style to capitalize on it, this is what's known as a systematic tactical asset allocation. Now, how you take advantage of this expectation differential depends entirely on your own personal trading style and risk tolerance. But here are a couple of examples of how it could be done. First, for a factor-based approach to building portfolios of stocks, you would want to alter your exposure to the more aggressive risk factors, with the scale of those changes depending entirely on risk tolerance. For example, you can increase your exposure to the market risk factor by decreasing cash or other low correlated assets and directly purchasing shares of the QQQ. You can also shift your exposure to the value factor by selling value stocks and purchasing a basket of high growth stocks within the QQQ universe. Lastly, you can add to your exposure to the momentum factor by purchasing a basket of high momentum tech stocks. For a refresher on how to identify high growth and momentum stocks, be sure to check out the video we did on using screeners. A second and perhaps a simpler way to add risk to your portfolio would be to capitalize on the inherent leverage in stock options. Leverage enables us to increase the return potential of our portfolio, and options allow us to do this for a specific set of time while also managing risk. And if we have the expectation of significant upward price action, options provide us with the ideal tool to monetize that view. If we look at our example of the QQQ following the November 14th CPI announcement, we'll see that the ETF was trading at just over $385 a share. And if we evaluate a roughly 6-week option expiring on December 22nd, we'll see that the price of a bullish, long at-the-money call was $9.33 a contract. This would have provided us with a leverage factor of just over 20 times, meaning that by purchasing this option, we're producing the same relative instantaneous return power that we would get by purchasing 20 shares of the underlying ETF QQQ, but at a significantly reduced price. By the way, if you had made this trade and held the option to expiration, it would have returned a 150% return on invested capital. Not bad.
Thank you, Brian. So there you have it. You don't need to follow every data to improve your investment journey. By following the right ones, you can already have a better approach to managing your portfolio. Our team of analysts is constantly working to deliver exclusive research, whether it's on our Instagram account or through our white paper collection. If you are curious about the effects of other critical events on particular stocks, check out our new key events widget. You could try our platform for free at visualsectors.com. Next week, we will decrypt PayPal stock and what we think the future could hold for it. Thank you for tuning in to Visual Sectors. We'll see you next time.